Okay, part 2 of chapter 6. We're going to continue now with LIFO, or last in, first out. So this is where we're taking the last thing we bought is the first thing we're going to sell. So when we're looking at that, the newest things that we buy are going to be what's in cost of goods sold, because the most recent things we bought are in cost of goods sold because we're selling them first. And that means that the oldest things, or the first things we bought, are sitting in our ending inventory. Let's look at the same example from before. So we have beginning inventory. We have 3 shirts at $10 each. And then we bought 5 shirts at $12 each. That gives us total goods available for sale of $30 of the $10 ones and $60 of the $12 ones. So we have a total of $90 of inventory available to sell to our customers. So last in, first out. The last things we bought are the first things we're going to sell. So we're going to do the same example where we're selling 4 shirts. So we bought 4 $12 shirts most recently, or last. So we're going to sell those. So we're going to sell 4 $12 shirts, and the rest is going to be remaining in inventory. So we're going to sell 4 $12 ones. We're going to have 1 left in inventory and 3 $10 in inventory. So our ending inventory ends up being $42, and our cost of goods sold ends up being $48. So we sold 4 shirts at $12 each. Our entry, still the same entry. We're still selling it for $20 to our customers. So we're debiting accounts receivable for $80 and crediting sales revenue. And then we're debiting cost of goods sold for the cost we just calculated, which we had cost of goods sold of $48. So we're debiting cost of goods sold for $48, and we're crediting inventory that we sold for $48. If we look at how it looks in our income statement, we have sales of 80 minus cost of goods sold of 48, giving us a gross profit of $32. Another example, just kind of showing you the perpetual inventory record from the beginning to the end, what it looks like using a different example. This one, again, it's the month of August. We started with 10 at $91, and we ended up with 5 at 91 and 7 at 115 in our ending inventory, giving us a total ending inventory of $1260 and total cost of goods sold of $4730. All right, our next method. This is weighted average. It's sometimes called the average cost method. So with this one, we're using the average cost of each unit to assign when we're selling our products. But every time we make a purchase, we're going to re-average. So we're going to take the total cost of goods available for sale divided by the total units on hand, and that's going to give us our average cost per unit. So again, using the same example, we have 3 $10 shirts and 5 $12 shirts. So we're going to add those together. We have 3 for a total of $30, 5 total of $60. We have 8 for a total of $90. So to get our average, we're going to take $90 divided by 8 units, and we get an average of $11.25 per unit. So when we're selling those, we're selling them at $11.25 per unit. So we're selling 4 shirts at $11.25, and we have 4 shirts left in inventory at $11.25. So our cost of goods sold is $45, and our ending inventory is also $45. Our entry is going to be, again, same entry. We're debiting accounts receivable, crediting sales for the amount we sold it to our customers for, and we're debiting cost of goods sold for the cost of our goods of $45 and crediting inventory for the same. Our sales minus cost of goods sold gave us gross profit of $35. All right, and here's another example of weighted average. And again, remember I said every single time we buy more inventory, we have to re-average again. So when we first started, we had 10 at $91. That gave us an average cost, $91 per unit. Now we have 10 at 91 and 15 at 106. So we have a total of 25 at 2,500. So we're going to divide that, 2,500 divided by 25 units. We get an weighted average cost per unit of $100 per unit. So when we're selling, we have 20 that we're selling, and we're going to sell at that $100 average per unit. So we're selling 20 at 100, giving us cost of goods sold of $2,000, and that's leaving us with 5 in inventory at $100 each. Now again, on the 17th, we're showing what we purchased. So now we're going to re-average. We're going to take that 5 at 100 plus 20 at 115. We get 25 total. Total cost of 2,800. We're going to divide 2,800 by 25 to get our new average cost per unit of 112. And then we can, the next time we sell, it's going to be selling from that. If we don't sell anymore, if we were to buy again, we're still going to re-average. Remember, every single time you purchase, you're going to re-average. And then when you're selling from that most recent average. All right, so what does it look like when you're comparing them? We did the sales minus cost of goods sold equals gross profit for the 3 different methods, and this is kind of how it looks. So we can see how that FIFO has the highest gross profit, LIFO has the lowest gross profit, and average is right in the middle. That's why it's called average, right? We're also going to see that that means that the highest gross profit is most likely going to equal the highest net income. A lower gross profit is going to equal a lower net income. And this based off of if inventory prices are rising or increasing. All right, so why would we use each method? Well, first in, first out has a higher income, so that attracts investors. Last in, first out has lower income, so that means we pay more taxes. And average kind of keeps you right in the middle, so it averages things out. So different companies choose different methods for different reasons, but these are some of the reasons. And if we look a little further, we can see again, our first in, first out, our ending inventory approximates our current cost, so what we have to replace it for. Last in, first out, the cost of goods sold on the income statement estimates the current cost, and then weighted average is going to smooth out all of those together. If we look at our financial statement here, we can see that, when we're looking at rising costs, FIFO is going to report the lowest cost of goods sold, which gives us the highest gross profit and net income. LIFO is going to report the highest cost of goods sold, giving the lowest gross profit and net income. And again, weighted average is going to be somewhere in the middle. When we have falling costs, FIFO is going to report the highest cost of goods sold, giving us lowest gross profit and income, and LIFO would report the lowest cost of goods sold, giving us higher gross profit and income. Companies can and do use different costing methods for financial reporting and tax reporting. There's only one exception, and that's if LIFO is used for tax reporting. In that case, the IRS requires that it is also used on the financial statements, and that follows something called the LIFO conformity rule. All right, our next section talks about lower of cost or market. And this is where we have to look at how do we report our inventory value. So after companies apply one of the 4 costing methods, whether it's FIFO, LIFO, weighted average, or specific identification, inventory has to be reviewed to make sure it's reported at the lower of cost or market value, also called LCM. So LCM requires that inventory be reported at the market value or the cost of replacing inventory if that market value is lower than the cost. So we say market in the term LCM, that's defined as replacement cost for LIFO, but net realizable value for the other 3 methods. And we'll talk more about those in intermediate accounting and advanced accounting later on. So a decline in market value means that we have a loss of value in inventory. When the market value is lower than cost, a loss is recorded. If our market value is higher than cost, no adjustment would be made. When lower cost of market is applied to individual items of inventory, the number of comparisons equal the number of items. So for this example, Roadster 140,000 is the lower of the 760,000 cost and the $140,000 market. For Sprint, $50,000 is the lower of the 50,000 cost and the 60,000 market. So this shows a 190,000 reported inventory computed from 140 from Roadster and 50,000 from Sprint. The journal entry records the adjustment downward of inventory to lower a cost or market, and that includes a debit to cost of goods sold and a credit to merchandise inventory for that 30,000 to report it down to the lower of the cost or the market value. All right, so one of the reasons we have to be very careful of how we report inventory is we want to make sure we don't have errors in our inventory because it affects our other financial statements. And we can see here at the inventory effects that if we have ending inventory that is understated, then our cost of goods sold can be overstated in year one and understated for net income. But then if you continue into the year two, we see cost of goods sold understated and net income overstated. And it's the opposite if it's overstated. So it does have an effect all the way through the financial statements if your inventory is incorrect. This is just another slide showing you how it affects assets and equity, in addition to how it affected the balance sheet or the income statement. All right, so we have a couple of ratios for this chapter. The first one is inventory turnover. We're taking cost of goods sold divided by average inventory. Remember, anytime we see the word average, it means we have to add two numbers together and divide by 2. This is going to tell us how many times they're selling through their inventory. The next one is days sales in inventory. We're taking our ending inventory divided by cost of goods sold, taking that answer times 365. That's going to tell us how much inventory is available in terms of how many days sales we have. This just kind of shows an example of Costco and Walmart. And if you look through them, you can see that Costco has inventory turnover that is increasing, and their days sales in inventory is decreasing. And Walmart has inventory turnover that is also increasing and days sales inventory that is decreasing. So we can look at how each of those would affect each of the companies, but for us, we're just focusing more on what is a good inventory, what is bad. So for us, inventory turnover is higher, and days sales in inventory is higher is also better. Okay, that concludes our chapter 6, and if you have any questions, please let me know.